Gold was supposed to hit $3,500 this year, but instead, it's falling, and nobody is talking about why. If you've been watching your gold investments drop and wondering what on earth is going on, you're not alone. And today, we're going to break it all down in plain, simple English. Stay with us, because by the end of this video, you're going to understand exactly what is driving gold lower in 2026, and more importantly, what might come next. Let's start with the big picture, because to understand where gold is going, you first need to understand where it has been. In 2024 and early 2025, gold went on an absolute tear. It broke through $2,000, then $2,500, then $3,000 per ounce. It was one of the strongest bull runs gold had seen in decades. People were rushing to buy, central banks were loading up, and the headlines were screaming that gold was the place to be. So what changed? Why is gold falling in 2026 after all that strength? The answer isn't just one thing, it's a combination of forces all hitting at the same time, and once you see them clearly, the price action starts to make a lot more sense. The first and biggest reason gold is under pressure right now is the strength of the US dollar. When the dollar gets stronger, gold gets cheaper in dollar terms, and that pushes the price down. Here's a simple way to think about it. Gold is priced in US dollars around the world, so when the dollar rises, it takes fewer dollars to buy the same amount of gold. That automatically puts downward pressure on the price. In 2026, the dollar has been strengthening because the U.S. economy has shown more resilience than many experts expected. Jobs data came in stronger than anticipated, consumer spending held up, and that gave the Federal Reserve less reason to cut interest rates aggressively. And that brings us to the second major reason gold is falling: interest rates. Gold does not pay interest. It does not pay dividends. It just sits there. So when interest rates are high and you can earn 5% or more just by putting your money in a savings account or a treasury bond, gold becomes less attractive. Why would you hold gold earning nothing when you can hold a treasury bond earning 5%? That's the question investors are asking right now, and many of them are choosing the bond. This shift in money flow is one of the key drivers pulling gold lower in 2026. Now let's talk about something that surprised a lot of people: the pullback in fear. Gold is what we call a safe haven asset. When people are scared, when there's a war, when there's a financial crisis, when uncertainty is high, gold tends to go up because people want something real and solid to hold on to. In 2024 and 2025, the world was full of fear. Geopolitical tensions were elevated. Inflation was hurting everyday Americans. There was uncertainty about elections, about the banking system, about everything. But in 2026, some of that fear started to ease. Certain conflicts moved toward negotiation. Inflation came down from its peak, and the economy didn't collapse the way many had predicted. When fear goes down, gold often goes down with it, because the panic buying that pushed prices higher starts to reverse, and investors rotate back into stocks and other risk assets. That rotation is exactly what we've been seeing this year. Let's also talk about what happened with central bank buying, because this was a massive driver of gold's rise. Central banks around the world, especially in countries like China, India, Russia, and several Middle Eastern nations, were buying gold at record levels in 2023, 2024, and into 2025. They were diversifying away from the US dollar, reducing their dependence on the American financial system. But in 2026, that pace of buying has slowed, not stopped entirely. But the urgency and the volume are not what they were. When the biggest buyers in the market slow down, prices feel it, and then there's the technical side of the market. This is something a lot of beginner investors don't pay attention to, but it matters. When gold hit all-time highs, a massive amount of money had poured into gold funds, gold ETFs, and gold futures contracts. All those buyers who came in near the top are now sitting on losses, and many of them are selling. This kind of selling creates what traders call overhead resistance. Every time gold tries to bounce back up, it runs into sellers who are trying to get their money back or cut their losses, and that keeps pushing the price back down. It's like trying to swim upstream. The current keeps pushing you back. Now let's talk about silver for a moment, because silver tends to follow gold, but with more extreme moves in both directions. Silver has also been falling in 2026, and for many of the same reasons: dollar strength, higher interest rates, and reduced safe haven demand are all weighing on silver just like they are on gold. But silver has an additional challenge. It's also an industrial metal. It's used in solar panels, electronics, electric vehicles, and manufacturing. And in 2026, there have been concerns about slower global economic growth, particularly in China, which is one of the biggest consumers of industrial metals. When economic growth slows, demand for industrial silver falls, and that adds an extra layer of pressure on silver that gold doesn't always face. So if you're watching silver prices, they may actually fall harder than gold before this is over. That's something to keep in mind. Now let's look at where things might go from here, because this is the part everyone really wants to know. First, let's be clear. Nobody can predict the future with certainty. Anyone who tells you they know exactly where gold is going is either lying or selling something. What we can do is look at the evidence and make an informed, analytical assessment. Here's what the data is telling us right now. If the Federal Reserve keeps interest rates elevated for longer, gold will likely stay under pressure, because the competition from yield-bearing assets like bonds and savings accounts will continue. But if the economy starts to slow down more sharply, if we see unemployment rise or a major financial stress event, the Fed will be forced to cut rates. And when that happens, gold historically bounces hard. Lower interest rates reduce the opportunity cost of holding gold, meaning it becomes more attractive again relative to bonds and cash, and money starts flowing back in. There's also the debt picture to consider. The United States is sitting on an absolutely enormous pile of national debt, and that debt is growing every single year. At some point, markets will start to worry seriously about the long-term purchasing power of the dollar. When that concern rises, gold becomes the go-to protection, because gold can't be printed. It can't be devalued by a government decision. It's been a store of value for thousands of years. That long-term fundamental case for gold hasn't changed. What's changed is the short-term environment. And in markets, short-term and long-term can pull in very different directions at the same time. Right now, the short-term environment favors a stronger dollar and higher rates, which is bearish for gold. But the long-term environment of growing debt, geopolitical shifts, and central bank diversification, that's still very much intact, and it still favors gold over time. For investors who are watching the current pullback with anxiety, here's the perspective that might help. Gold has had corrections before, sometimes sharp and painful ones, and every single time over the past several decades, it has eventually gone on to make new highs, because the forces that drive long-term gold demand don't go away. The question isn't whether gold will recover, the question is when, and what price will it be at when you decide to pay attention again. The people who got frustrated and sold near the bottom of previous corrections often missed the next big move up, and those who stayed patient and understood the big picture were rewarded. That doesn't mean you should buy blindly right now. It means you should understand what you own, why you own it, and what conditions would change the story. Right now, the story is, gold is falling because the dollar is strong, rates are high, and short-term fear has eased, but the long-term fundamentals that drove gold to record highs are still in place. When the rate environment shifts, when the dollar weakens, when the next wave of fear or uncertainty hits the market, gold and silver will likely be among the first assets to respond. Watch the Federal Reserve closely, watch the jobs numbers, watch what happens with the U.S. debt ceiling and government spending. Those are the signals that will tell you when the wind is about to change direction for precious metals, and when that wind shifts, it can shift fast. That's the update for today. Gold is falling in 2026 for very real, very understandable reasons. But the story is far from over. If you found this breakdown helpful, make sure you hit that like button and subscribe so you don't miss our next analysis. We break down gold and silver markets in plain English every week so you always know what's really going on. Drop a comment below and let us know. Are you buying this dip, holding, or waiting on the sidelines? We read every comment and we'd love to hear your strategy. Until next time, stay informed, stay patient, and keep your eyes on the market.